Do you have good tips to avoid capital gain taxes from investments, inheritances, etc.?
Yeah, well, so first of all, from an inheritance standpoint, under current law, you get a stepped up basis. And this is something to really understand because I've seen people make some mistakes here. What that means is that uh, if you inherit a house from your parents, they paid 100,000 and it's worth 1 million, right? Normally there would be a big capital gain on that, but what happens is they allow you to step up the basis from that 100,000. I'm being very simple here, but there's a whole bunch of things that go on, but from that 100,000 right to the value at the date of death. So you go out and get a appraisal, and they say it's worth 1 million. Then that is now your cost basis. If you sell it, there's no capital gain, and so that actually relates again to a parent situation where they're in a nursing home or something and you need the money. I've seen people sell their parents' homes, pay this monstrous capital gain, and maybe a better idea would have been to try to rent that home to pay for, if possible, and pay for the nursing home or part of the nursing home. And then if the parent does pass away, you get that step up basis. So you get rid of that capital gain on inheritance. And that happens with stocks, that happens with really anything that is appreciated. You can reevaluate it, even collectibles, and set the price at current price. And then, if you end up selling it, pretty soon after that, you might not have any gain at all. Uh, Normal scenarios where it's not an inheritance, where you're just trying to avoid capital gains, those are much more difficult. There are some esoteric concepts out there I don't subscribe to. I basically look at it as, hey, there's a price to pay for making money. That's kind of it's not a bad thing. They don't take all of it. Uh, and I've actually seen people actually try to reduce their gain to try to reduce their tax. But if they take 25% and you reduce your gain by, 100,000, try to make less, you actually just lost 75,000 net. You just make as much money as you can and give part of it to the government. But I will say one strategy that we use all the time. I buy, pieces, these ETFs for these portfolios all the time. They don't always work, right? And so I will take that loss. Whenever I can, I try to take a loss. I take a loss, take a loss. Overall, I want to hold on to my winners and sell my losers. And when I'm taking those losses, I'm accumulating this write-off. And then when I take gains, I can use that accumulated write-off against those gains. So if I end up taking $10,000 worth of losses during the year, I could take $10,000 worth of gains, say at the end of the year, have no tax. Uh, the last piece would just be hold on to things for a year, right? Because the capital gains tax is much lower if the long-term gain tax is better if you hold on to something for a year versus if you sell it before that. If you have a loss in 3 months or something, okay, great, take it, move on to something else, capture losses. But if you have a gain in 3 months, if you sell that, uh, you don't want to hold on to something for a year just for tax purposes and watch your gain disappear. So if you really need to, take it, pay the tax. I have seen more people lose money in the investment world trying to avoid tax. It's amazing. All of these things, these limited partnerships, all these things that have come out, and people are trying to avoid tax, and it's like this huge issue. It's amazing to me, actually. It just boggles my mind. They don't take it all. Keep that in mind.
Yeah, the IRS is always playing whack-a-mole with those loopholes and trying to just get rid of them slowly.
Oh, definitely. Well, we're running, massive deficits. And so they're always looking at different things to try to, get more tax revenue in as a whole. So yeah, that's something to keep up on as to how they're doing it. There's been some talk about increasing capital gains for above $1 million. There's been some talk about reducing or eliminating the step up that I just talked about also. So these are things to keep in mind and keep in front of. They could be fairly costly mistakes, so it's worth spending some time on that. And again, that's why tax planning is such a critical issue. It's why we incorporate it as one of our 4 pillars of success for building wealth. It's why we have a tax planning, playlist on our, channel. It's why we're creating these resources because I believe tax is a big issue that you can really try to learn about and try to get better at because you know, paying more or worse, losing more because you're trying to avoid taxes. Those are 2 areas you got to be careful with.